Moody's downgraded the US last week. It may have a technical impact because many investors have rules that include credit ratings on what they're allowed to own. But really, nobody should need to hear from Moody's to be concerned about our fiscal outlook. We're facing a looming disaster as baby boomers retire and the cost of entitlements, especially Medicare, head higher. There haven't been any votes in being a fiscal conservative since Bill Clinton was running for office in 1992. I've always believed that the solution would be higher inflation. Not the hyperinflation of Latin America, but a bit higher than the Fed's target of 2%. Inflation is how governments with too much debt have solved the problem going back centuries. I wrote about this in a book called Bonds Are Not Forever: The Crisis Facing Fixed Income Investors. It's over 10 years old, but the underlying concepts are still just as valid as they were when I wrote the book. Inflation reduces the purchasing power or real value of what you owe. If you can keep interest rates close to or below inflation, it means repaying less in real terms than you borrowed. Interest expense is now more than our defense budget. Consumers are beginning to notice. I was surprised recently to see that the University of Michigan survey showed that inflation expectations have risen sharply. They've been doing these surveys for decades. People think inflation over the next several years will be around 4%. That's a long way from the Fed's target of 2%. A quarter of the respondents thought inflation could run at 10%. I found it very interesting that the Michigan survey's inflation forecast is pretty accurate. Consumers are quite good at forecasting inflation. And today, they're the most concerned they've been in over 30 years. It's probably due in part to the fiscal outlook, but I don't think anyone could confuse President Trump with a hard money guy. Real estate usually does fine with inflation, and as we know, that is his background. Threatening to fire Fed Chair Jay Powell for not cutting interest rates isn't the behavior of a guy who wants to reassure the holders of our $36 trillion in debt. I think for investors there's plenty to be concerned about. This is why midstream energy is such a good investment. Regulations allow many pipelines to raise their fees by the Producer Price Index, or PPI. In 2022, that meant 13% hikes. It means that the owners of pipelines get inflation protection since their revenues will go up accordingly. Dividends are well covered by cash flow, leverage has been coming down, and this is a sector with pretty good visibility because the amount of oil products we use is pretty stable, while natural gas consumption just keeps going up because of demand for exports and to power data centers. The risk of a little higher inflation is going up too. At a time like this, we think midstream energy infrastructure is a sector every investor should consider. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. If you have any questions you'd like answered in this video, then please leave them down below. I'm Simon Lack. Thank you for watching this video.